Todd, let's talk about where we are. What do you see in the charts right now? Because we're all kind of scrambling at the moment, trying to understand what is happening here. And these are the points at which we need a little bit of help. So what are you seeing right now? Let's start with the S&P.
Yeah, absolutely. It's great to chat with you. I want to put a little context on the back of this rally. The average bear market bounce since 1954 is about 15% over 32 trading days. And with today's action, we're pushing about 16% over 37 trading days. So we're right in the thick of historical comparisons. And now that lines us up pretty nicely with where we are in the teeth of resistance for the S&P 500. We pushed through 4240. Now I would look closer to 4300 to 4330, where the downward sloping 200-day moving averages. It's a very tricky market here. We're very overbought, perhaps in the thick of a trend change, but you're encountering a lot of overhead resistance. So I think you have to play it very, very tactically in the meantime.
And Todd, it raises the question sort of when does a bear market rally become an actual legit rally that then you have to buy? And there seems to be some indicators that we need to start seeing first. And I'm wondering, what about the percentage of stocks above certain moving averages? What does that tell us about the breadth of the rally?
Yeah, so our go-to indicator for this is the percentage of stocks above their 50-day moving average. It measures internal momentum and if there's real credence to this rally. If you go back the last 70 years, every major market low was accompanied by this indicator getting above 90%, right? 90% of stocks above their 50-day moving average. Great price momentum. We're at about 84%, a little higher this morning. So right on the cusp of a confirmation signal, if you want to put it that way. I would note, though, if you go back to spring 2001, you got to about 88, 89%. That turned out to be a head fake. So that's why it's so important that you really do get over that 90% threshold to say, this is the real deal, the lows are in, and we're going to try and make a challenge towards the highs from January 3rd.
The real action has been in the NASDAQ. 20%. We're up 20%. That I find absolutely amazing. This, in some ways, is a bull market. Is it?
Well, again, you're going into sharp resistance. You haven't made a new higher high yet on many of the indices. And on the Qs, 340 is the next resistance level. But I also want to pay attention to the NASDAQ 100 relative to the equal weight S&P 500. That is the most important risk relationship in our work right now, because it's going to tell you, do we favor growth, as it's been the case over the last 6 weeks, or does it go back to the value and average stock winning, the industrials, the energy names, the financial names that we saw for much of 2021? I think that's consistent with better participation rather than just Apple and Microsoft pushing this rally higher. And so, yeah, I think there's some important inputs there, such as what do rates do, and if the dollar continues to decline, that should aid, at least on the value side of the relationships here. So again, keep an eye on that barometer for where to skew your relationships. And again, as the NASDAQ hits that 340 area, important resistance.
Hey, Todd, before we let you go, if the NASDAQ and if the S&P kind of break the resistance, what is it going to tell you after that? Does it matter sort of how powerful the rally is after that? Where do we go then from there?
I would keep an eye on other risk barometers. Discretionary versus staples was a great tell coming off the March 2020 lows. That told us cyclical risk-seeking appetite. I'd look at high beta versus low beta. So you want to make sure when you start to break out, is it being accompanied by offense on the field? I'd rather not see utilities and staples leading the market higher. That just tells me that there's skirmish hands. And so I think the more risk-seeking appetite you get as you encounter these resistance levels and break out over them, the more confidence we have in the market.